Jamie Dimon. He's the chairman and CEO of JP Morgan Chase, the largest of the big four American banks. He's one of the most well-known voices in finance, and due to his position at the top of one of the world's largest banks, he has insights into the financial markets and the economy unmatched by virtually anybody. That is why it raised a huge red flag for me when I heard what he had to say about what's currently happening in the United States housing market. Given that the housing market is a multi-trillion-dollar industry and, as demonstrated by the Great Financial Crisis, can have a devastating impact on the global economy, people should be paying special attention to what's going on with housing prices. On the back of historically low interest rates and limited supply, prices for houses in America have increased dramatically over the past 12 years, with the median home price hitting an all-time high of $350,000. This drastic price movement is starting to worry Jamie Dimon, who is warning of a bubble forming within the housing market. Listen to this clip of what he had to say.
Senator, to give you a little comfort, while it is a little bit of a bubble in housing prices, stuff like that, unlike 08 and 09, there was tremendous leverage and bad mortgage underwriting. Here, there's not much leverage and much better mortgage underwriting, so it wouldn't have the same effect on the financial system as we had last time. And I think all these banks, we have our capital runneth over. We have enough capital to withstand multiple crises. We did as we did in 08, as we did in the pandemic. We run 120 stress tests a week, some of them far more severe than the Federal Reserve severe adverse test, and we can handle all of that rather easily.
Before we go any farther, it is important to understand what exactly is causing home prices to increase at such a fast rate. The rise in prices can be attributed to two main drivers, the first being historically low interest rates, and the second being historically low supply of available houses for sale. On the first point, due to actions taken by the Federal Reserve, interest rates for mortgages are some of the lowest rates in the history of the United States. To truly understand the housing market, it is important to understand the drastic impact that interest rates have on home affordability. Generally speaking, the lower the interest rate on a mortgage, the more someone can spend on a house, all else being equal. To demonstrate the impact interest rates have, let's look at an example of a 30-year mortgage on a $350,000 house with a 20% down payment at a 3% interest rate. At a 3% interest rate with the given criteria, the monthly mortgage payment would be $1,476. If you increase that interest rate to 5%, that mortgage payment would rise to $1,879. And if you increase the interest rate even farther to 7%, that mortgage payment would shoot up to $2,329. Using this example, that means a home buyer would pay nearly $1,000 more every month for 30 years if the rate on their mortgage was 7% as opposed to 3%. Once you think about it in these terms, it is much more clear why and how interest rates are able to move home prices so much. The lower interest rates are, the more people can spend on a house without increasing their monthly mortgage payment. This helps to explain that even while home prices have skyrocketed, home affordability hasn't dramatically decreased. Home affordability, as measured by the Housing Affordability Index, is still substantially above 2005 and 2006 levels in the build-up to the housing bubble that caused the Great Financial Crisis. Another main driver of this surge in pricing is historically low inventory. Just go on the popular real estate listing site Zillow or talk to a real estate agent, and it will quickly become apparent just how low inventory is for houses. There are many people looking to buy houses and not many people wanting to sell, and as a result, prices have increased. In certain hot real estate markets such as Austin, Texas, bidding wars have become extremely common. Homes are getting multiple offers on the same day the house is listed, with many of those offers coming in significantly above what the house is listed for. It is just basic economics and supply and demand. When there's a limited amount of a certain thing available and a lot of people want it, the price of that thing goes up. While availability of supply is currently at an extreme, limited supply of houses on the market is not new. In fact, the lack of single-family homes has been a structural issue for more than a decade. New construction of single-family houses has not kept up with the demand for single-family homes since the financial crisis. The Great Financial Crisis and the subsequent severe economic recession and decline in home prices caused home builders to be cautious, dramatically cutting back on production. Instead, many developers have focused on building large apartment buildings. A study from Realtor.com found that 5.9 million single-family homes that were built between 2012 and 2019 are insufficient to offset the 9.8 million new households formed during that time. That is a deficit of nearly 4 million houses that would have needed to be built just to keep up with the demand for housing. This problem has even gotten worse due to the increase in the cost of materials to build houses skyrocketing. Take the cost of lumber, for example, which is more than 3 times more expensive now than it was just 18 months ago. This shortage of available single-family housing has been a driving factor in the increase in the price of homes over the past decade and rarely gets enough attention in the media. Given the similarities in how recently it happened, this rise in home prices is being compared by some to the Great Financial Crisis. There are two key reasons why this is a different environment than in 2008 and 2009. 1. Mortgage underwriting standards are much more strict, and 2. Home affordability still remains significantly higher than it was in the build-up to the Great Financial Crisis. On the first point, bank and mortgage originators learned their lesson when the real estate bubble popped in 2008 and 2009. It is now much more difficult to get a mortgage than in the run-up to the Great Financial Crisis. Back then, it was so easy to get a loan that a term was coined, Ninja Loans, which stands for no income, no job, and no assets. This term applies to loans extended to a borrower with little or no attempt by the lender to verify the applicant's ability to repay. To put it simply, a lot of people received loans to purchase homes who were very risky borrowers, and once the economy started to slow down, these people quickly fell behind on payments. This is a stark contrast to now, where the average home buyer has a credit score of 731, which is considered a prime or very creditworthy borrower. Now, let's take a look at home affordability, both now and in the build-up to the financial crisis. To do this, we are going to look at the Composite Housing Affordability Index. The Composite Affordability Index is a measure of home affordability in the United States. Values over 100 indicate that the typical or median family has more than sufficient income to purchase the median-priced home. Or, to put it another way, the higher the number, the more affordable it is to purchase a house. In 2006, the index score was 107.6, meaning home unaffordability was at or near an all-time high. Compare that to now, where the index score at the beginning of 2021 was 187. Meaning home ownership now is significantly more affordable than in the build-up to the housing bubble that led to the global financial crisis. Now that we understand what has led to this huge run-up in housing prices, that leads to the next logical question. What could cause this strong price momentum to slow down? The biggest and most likely thing that could cause the housing market to cool off would be an increase in interest rates. As demonstrated by the earlier example, when interest rates rise, the price that a home buyer can pay for a house while keeping their monthly mortgage payment the same, decreases. However, with that being said, the United States Federal Reserve, the group that has the ability to increase or decrease interest rates, has stated that they plan to keep interest rates low for at least the next couple of years. That means these historically low interest rates are here to stay, for now, at least over the next 24 to 36 months. It's without question that home prices can't keep rising at double-digit percentage rates forever, but that doesn't mean that prices can't increase a lot from where they are now before price levels start to slow down or plateau. So there we have it. Thanks for watching, and I hope you enjoyed the video and learned something useful. Make sure to like the video and subscribe to the channel because it is my goal to make you a better investor by studying the world's greatest investors. Talk to you soon.